What's up, future CPAs? Welcome back. Okay, let's just jump right into it, because today we are tackling a topic that absolutely loves to pop up on the board exams, just to mess with people: Treasury shares, and specifically the par value method and retirement. I know, it sounds super specific, but trust me, getting this down is like having a secret weapon. So let's make it click and make it stick all the way to your LECPA and beyond.
Okay, so first things first, let's ground this in our world, right here in the Philippines. This isn't some abstract theory. It's literally written in Section 9 of our revised corporation code. Put simply, treasury shares are a company's own stock that it decides to buy back from the market. So these shares were out there, living their best life with investors, and now the company's brought them back home into its own treasury.
So just picture it. A company shells out some cash, and boom, it's now holding a bunch of its own shares. The huge question for us as accountants is, so what do we do now? How on earth do we record this? Because the answer to that question sends us down one of two totally different paths on our accounting journey. So you might be wondering, why would a company even do this? Well, there are a bunch of reasons, actually. Maybe they need shares for an employee's stock plan, or maybe they want to send a signal to the market that, hey, they think their own stock is a bargain right now, or maybe they're getting ready for a merger. Whatever the reason is, once those shares are back in the company's hands, we've got a job to do.
And this slide right here, this is everything. This is the big fork in the road. The accounting method we pick depends completely on what the company intends to do with those shares. If the plan is just temporary, hold on to them for a bit and then sell them again, we use the cost method. Simple. But if the goal is permanent, to get rid of those shares for good, to make them disappear, then we have to use the logic of the par value method.
Now, I know what you're thinking, but wait, isn't the cost method used by like 99% of companies? And yeah, you are absolutely right. For just holding treasury stock, it's the main method. But, and this is a huge but for the LECPA, when it's time to actually retire those shares forever, the logic we have to follow comes straight from the par value method. So it's not some obsolete thing you can forget. It's a special tool for a very specific job, and you better believe the board exams love to test those special tools. All right, enough with the theory. Let's get our hands dirty and actually build the journal entries for this par value method, one step at a time. Don't worry, if you just follow the logic, it all starts to make a whole lot of sense. So when a company buys back its shares using this method, the entry gets broken into three parts. First, we debit the treasury stock account, but, and this is the most important part, only for the par value of the shares. Second, any extra money we paid above that par value gets debited against our equity accounts, usually starting with additional paid-in capital. And third, of course, we credit cash for the total amount we paid. Let's put some numbers to that. Say we buy back 1,000 shares at $10 each, and their par value is $5. The treasury stock account gets a debit for 1,000 shares times that $5 par value, so $5,000. The cash we paid out is 1,000 shares times the $10 price, which is a $10,000 credit. So where does that $5,000 difference go? That's the premium we paid, and it gets debited to APIC. See what we're doing? We're essentially breaking down the original stock sale right from the moment we buy it back. Okay, fast forward a bit. The company decides, hey, let's sell some of these shares again. And lucky for them, the market price is looking good. It's above the par value. This is the easy one, the happy path. We debit cash for all the money we get, we credit the treasury stock account to take those shares out at their par value, and all that extra cash we made, that becomes a credit to additional paid-in capital. Here's how that looks. We reissue 500 shares for $15 each. So cash in the door, 500 times 15 is a $7,500 debit. We take the treasury stock off the books at par. 500 shares times the $5 par is a $2,500 credit. And that leftover $5,000, that's our credit to a PIC. Now notice what's not here. There's no gain on sale hitting the income statement. Remember, this is an equity transaction between the company and its owners, not a sale to a customer. But what if the market takes the dip and we have to sell the shares for less than par value? Okay, this is where it gets a little tricky, so lean in for this part. We still debit cash for whatever we managed to get, and we still credit treasury stock at its par value. But now we have a shortfall, a loss. We have to absorb that. We first debit any related APIC from our treasury stock deals. If that account gets wiped out, we have to dip into retained earnings for the rest. And here's the why behind that whole process. This is like a golden rule in equity accounting. Think about it. Contributed capital accounts, like APIC, represent the extra money shareholders have paid into the company. You can't have a negative amount paid in. That doesn't make any sense. So any loss that's too big for APIC to handle has to come out of retained earnings, which is the capital the company has earned over time. Okay, it is time for the big reveal, the aha moment. Why did we just spend all this time learning the par value method? Because we finally reached our destination, share retirement. This isn't just holding on to shares. This is about making those shares completely vanish as if they were never even issued. And to do that, the par value method's logic is our map. And let's be super, super clear on this. Retired shares are canceled. Poof, gone. They permanently lower the number of shares the company has issued. They can't be reissued later because they don't exist anymore. They are literally wiped off the company's books. So how do we record this final move? This is a classic LECPA question setup. Compare the journal entry for retirement under the cost method versus the par value method. This is where you can really score some major points, so pay close attention to what's coming next. So if we were holding this stock using the regular cost method, retirement is a bit of a process. We have to debit common stock for its par value, and debit the original APIC from when those shares were first sold way back when. Then we credit Treasury stock for the actual cost we paid to buy them back. And any difference between what they were originally sold for and what we paid to get them back, that gets plugged into either APIC or retained earnings. Now, look at this. Look at the beautiful simplicity. If we've been using the par value method's logic all along, our Treasury stock account is already sitting there at par value. So to retire the shares, we just debit common stock at par and credit Treasury stock at par. Done. It is a perfect, clean reversal. It's so elegant. And here it is, the punchline for your exam. After all of that, the final number for total shareholders' equity will be exactly the same no matter which method you used. But the journal entries to get there, the very thing they're going to test you on, are completely, totally different. That's the game. Okay, let's lock all this knowledge in. We've gone through all the details. Now let's boil it down into a cheat sheet with some brain hacks that are designed to stick with you, not just for your next quiz, but for that moment when you're sitting in the exam hall a couple years from now. If you remember only one single thing from this entire explainer, please make it this sentence. The cost method is for a temporary hold. The par value method is for a permanent retirement. Just link the P in par with the P in permanent. I promise you that one little trick will cut through so much confusion. Now for the rules that examiners absolutely love to build their trick questions around. Rule 1, no gains, no losses on the income statement, ever. This all happens within equity. Rule 2, APIC can't go negative. Retained earnings is your backup plan. And Rule 3, retirement is final. It's a permanent cut to the number of issued shares. You got to burn these into your brain. And just to hammer this home one final time, according to PAS 32, what is the magic number that hits your profit or loss statement from buying and selling your own company's stock? It's 0. A big, clean 0. It's a capital transaction, plain and simple, end of story. So we've nailed the journal entries. We've got the rules down cold. Let's end on a bigger question. Now that you know the accounting for literally erasing shares from existence, think about this. How can a company use that action, retiring its shares, as a powerful signal to investors that it's super confident about its own future? That's the next level. That's the leap from just booking the numbers to truly understanding the story they tell. Good luck with the review, and I'll catch you in the next one.